The US market just made an all-time high, but investors and traders are looking towards rate cuts for the next big move and catalyst. Are they correct in such a top-heavy market led by semiconductors though? Well, luckily we've got the latest Goldman Sachs data to break down what happens in a rate-cutting environment before and after. And more importantly, what's going on this week with the OPEX and trillions of dollars of options expiration. There are some exhaustion signs coming, and we need to discuss it together along with what's going on with yields, Tesla's big breakout and huge flows, and of course the crypto market starting to crash and showing signs of maybe a bit of bearishness coming in. I'm tending to go towards something very different though to most people. So let's go with stocks, commodities, and cryptos and break down everything together right now. This will be a good one. Join us. Well, what's up everyone? Welcome back. My name is Tom, and as always, we're going through the latest macro, data, lead indicators, and of course the hottest charts together. If it's your first time here and you haven't subscribed, remember to do so and smash that bell icon if you want to find out more about where flows are moving, and of course some of the best macro data on the internet right now. So let's break down what's going on with this particular discussion about first Fed rate cuts and whether we're going to get one in September, December, or whenever. It doesn't really matter that much. What we're interested in is what happens before and how markets perform, and generally the first 3 months after the cuts actually occur. Now, there are three main things that happen: normalization, growth scares, and recessions. Let's look at a growth scare first. Generally, the market will go ballistic around 6 months out from the actual cut itself, and then blow up kind of about 1.5 to 2 months before the cut happens. Now, if you see something like that, that usually is more growth scary. It can also be recessionary though. So it's a little bit different to normalization. Basically, it's saying the market's running out of steam and there's serious concerns about whether the economy is continuing to grow. We need stimulus and we need it now. And that comes often in the form of rate cuts from central banks. The next one is normalization. This is basically where the market is performing very, very well, and they slowly do some rate cuts just to kind of keep it ticking along. This is something we saw from the 2010 period into the kind of 2000 and let's call it 18 period. We kind of had like this decent market. Then we tried to raise rates, and of course we started to cut them to try to normalize it after that. Ended up being into a mini recession, but at this point that's something that you'll be looking at. So you got the normalization, the growth scare, and then of course the recession. The recession generally comes when you've got that yield curve inversion, which we have right now, and you've got pretty much everyone not realizing that it's going to come. And that's actually shown in the charts here by a very small pullback before a rate cut happens, and then it tends to be, of course, a much, much worse period of time. So the recession is the one that everyone's worried about. So how are we going to actually spot whether a rate cut is actually coming or not? Well, a lot of it comes down to understanding which markets will perform the best. After the first Fed cut, value generally will lead growth for the first 6 months. So specifically, again, the first 3 months in particular, you tend to see value doing quite well. Then small led large, 3 months, 6 months, and 12 months, and bonds end up leading stocks. And you can see here bonds do very well 12 months after the rate cuts start. And that's generally due to mostly recessionary stats. So what are we looking for around 3 months out from a rate cut? Well, really, we're looking for the bonds market to perform very, very nicely. And Treasuries has been doing okay recently. Bonds have been doing okay. And of course, that's something that we are looking for. But we'll want to see them do even better if the market is to be actually believing that they're going to do a rate cut in September, which I'm still skeptical of, but you never know when it comes to elections, politics, and everything else. So let's have a look here at whether the sectors could tell us something. Well, generally the outperformance happens in two main sectors: consumer staples, and then we get also the financials. And you'll notice that I talk a lot about financials specifically during this period of the cycle, and why that is because it's important specifically for XLF to constantly be doing better and better and better. That usually means that we've got a higher rate, they're lending very well, they're still writing debt, and then of course they tend to do horribly after rate cuts come through, because that means there's usually a sickness in the economy, and specifically that will hurt generally financials the most. So remember, they are very sensitive. Financials and energy are some of the most sensitive to rate cuts and rate hike sectors out there. So two to be watching on your chart specifically, especially XLF versus the SPY and also XLE versus the SPY. Two great combos in your TradingView platform if you want to set them up. So let's have a look at a bit of the macro data in terms of indicators, where we're at right now leading into this week's $1 trillion option expiration. We'll start off here with macro charts, and you can see that he's got his indicator, which has been pretty good at calling tops in terms of a bit early, but obviously starting to show exhaustion. That's now tied for the most extreme overbought level in 10 plus years, monitoring for it to turn down. So he's obviously looking for a turn with price action, so again, confirmation, which we talk about a lot in this channel, to actually show that maybe a temporary top has been put in for now. Now, the reason why you could also ask or answer the question of maybe we need a temporary top is take a look at this chart here. So this is basically a chart where it hasn't been seeing any kind of massive 4% day move on the downside, and that hasn't happened for quite some time. So it's basically like the calm. Now, you will generally get a lot of calm in very bullish markets. So you'll see here there's only 2 days that really hit it. We've got one in this bull market so far since October of 2022, and we haven't really had one of those scare points. Eventually they will happen. It's the nature of markets. So of course, we're starting to get into those data points right now where we're getting a little bit stretched from having like a real freak out in the markets. S&P 500 also is continuing to make all-time highs and not really show signs of overall weakness just yet. Again, it's being led by semiconductors, and I would suggest having things such as the chart we're going to show later on in this video on your particular watch list, because it will be important to have a look at. So what about JP Morgan's latest institutional weekly survey? What are they doing? Are they buying? Are they selling? Are they just holding? Well, it looks like they're kind of holding, but they're not necessarily planning to increase equity exposure. Now, I take these types of reports with a grain of salt because generally speaking, they're not that good. But it is a quick read here, and you can see current, they're running at around 17%, which is one of the lower reads. Now, you might remember that when they were here last time, we were close to a topping point that ended up selling off into, of course, the October period, and then became quite a nice point. And they actually maximized themselves around November with some massive turns in the market. So you can look at this report and kind of say, well, maybe they're not quite too hot on the markets. And I think one of the reasons why is it looks a little stretched when you consider just those couple of semiconductor stocks really pushing us higher and higher and higher. Here's the Q breadth showing us the same thing, breadth down, breadth down, breadth down. As we've already shown in other videos, it doesn't necessarily mean the markets will crash or fall. It just means that it really is being run similar to a dot-com bubble or the 1960s, where we get an incredibly concentrated market, and really you have to be watching those stocks the most. Cyclical bull market returns do tend to go longer. This is taken from May, but obviously we'd just be here in June. And we do have quite a long runway to go. We're in about month 22, 23 at the moment. And we do specifically look towards the average median duration between 31 and 33 months. So that takes us really to the end of the year into 2025. And generally speaking, we might have a problem first or even second quarter or even later on that year. But the bull market still isn't really even at what you would expect it to get to, which is the median duration. What about balance sheets? Well, this is a tale of two different types of data. Households have continuously improved according to some readouts out there. Household debt as a percentage of GDP has actually been on the decline for quite some time after hitting massive spikes before, of course, the GFC. And then American have actually hoarded cash since the 2020 period. And you'll notice here, some of the balance sheets look pretty good. Now, on the flip side of this, and this is just showing you different data points, you can see here this chart aggregates personal savings compared with pre-pandemic trends. And when you take a look at this one, you'll notice that overall it kind of looks kind of red. And what it's showing is that probably a lot of the middle class and lower class are living a bit on credit cards. And they're starting to live on pay now or buy now, pay later, that type of stuff. Now, it's my estimation that a lot of people are going to be borrowing all across the board, even at higher rates, mostly because I think debt is getting a little bit easier to get out there. And specifically, this is leading into, of course, the market also rallying across the board and financials being the one to watch. Quick update, we also are posting our US 500 charts over on X, so make sure to follow in the links in the description down below. But let's have a look here at what's been happening with some of the big transactions, because we mentioned the other day that Tesla looked like it had broken out. It dropped back down and filled the gap. And as it happened, it filled the gap on a very heavily traded zone. Some large transactions coming through about 2 weeks ago at around this area. And then, of course, it had that classic kind of drop-off before rallying very hugely. Now, it's since rallied quite a lot over the last 24 hours, another 5%, but it may even go harder this week based on the options analysis we'll do in a moment. So some big trades coming through there. Some other big trades as well coming through the S&P 500 3 times funds. And you'll notice here they're dark pool and normal on market trades, and they're all happening at around the same levels. Now, why could that be? Well, it's my estimation that someone is probably doing a little bit of profit taking. And this doesn't mean that the market falls straight away, but it is a sign, along with that macro bonds, along with what we'll show on the charts in just a few moments, that we're probably getting a little exhausted from this move. And we're within 20, 30 points of what I would call an incredibly critical level. The 5,500 zone to the 5,510 in particular we're looking at. A few other charts here that I thought were interesting. This is the NASDAQ Volatility Index versus the CBOE VIX Index. You'll notice it's kind of in the middle of nowhere land. It just shows you that I don't think volatility indicators are necessarily showing us anything specific in charts right now. And this is another one that I think is really weird, which is stocks up, breadth is down. We are now in an outlier point that we haven't been at since around the 26th of June last year. Now, if that sounds familiar, it probably should. Firstly, it's around the same time. And secondly, soon after this, we effectively got to the point, or 26th of May, sorry, is what I mean. Soon after this, we got to that kind of spiky moment in the markets where we got that pullback that led into, of course, a nice rally. But that could be again coming. And you've got to remember that if it's the same timing, let's say 2 months still away, I don't think it's that far, but let's just say it is 2 months away, then that would push us into kind of that August-y period to September period. And that tends to be also what we see in election years. Let's have a look whether the markets are continuing to show any signs of weakness when we look at the sectors. Well, funnily enough, we did see XLY break out big time over the last 24 hours. And we actually saw that starting to appear quite a few days ago. So it shows you why you need to be doing sector analysis. In particular, we liked Shopify. So Shop was doing incredibly well, and that was breaking up in a huge way and actually ended up doing very nicely. It moved like a semiconductor stock, hitting its first take profit target over the last 24 hours just before then. What about this in terms of the last 5 days? Well, it's really, again, those sectors that we've been looking at. And it's good to see home builders and regional banks starting to stabilize. Again, as a bull, that's the type of thing you want to see. And it's been technology, semis, and consumer discretionary for now that's doing very, very nicely. Let's now jump into the charts and have a look at the S&P 500. And the first thing I think would be that we're starting to see signs of exhaustion. Now, we've had these before, and they usually are a little bit early, and I said this in our last video. You can see here we've had some signs of exhaustion, then kind of dropped off, got a little bit of a pullback. Here's some signs of exhaustion. They only dropped for like a day, and then it came back, and some signs of exhaustion, we went sideways, what's known as a pullback in time. Now, this has been a very aggressive trend, but I generally do take these types of signs of exhaustion and I pay attention then to the options market as well and the key levels. So let's have a look at those together. And some of the key levels over the last 24 hours, well, of course, just before 5,500 and 5,500 including, these is key zones for us to be looking at. We need to see how the market reacts here. So I think 5,500 to 5,510, which just so happens to be the options move expected high, they're going to be zones that this week, particularly with OPEX, I would expect the market to try to sell off from. Also, if it does sell off, which levels might buyers be sitting at? We've got a lot of anchored VWAPs sitting around 54.30 to 54.36, most traded zone, 1 day expected move. I would expect that to be a decent area. Then we've got 53.56. And of course, if we keep dropping down, then we start to get into the 52.80 and even lower levels. And we'll break those ones down if they do happen. But for now, these are the two major bull zones, I think, for day traders and even swing traders. Right here, and right here with the possibility of seeing structure there. And as I always say, if it comes down really aggressively for whatever reason, always have patience. It's very important to react to the market and not necessarily predict. You can find great zones using technicals, but always do look for that activation principle. So these are the key ones. We did share this chart over on X as a reminder as well. Let's now have a look at the options market. Now, why am I saying 5,500? I think it becomes blatantly clear when you have a look at the 0 DTEs this week, and then you have a look at the OPEX, which is of course on this week in terms of expiration. 5,500, 5,520, super stacked with options everywhere. We're still in a positive gamma environment, so it's not like the markets are, predicting full turnover or anything. But I just find it difficult to think that we're going to be too much above 5,500 by the end of the week. If we are, a lot of hedging is going to have to come through. If that makes sense, then let's also have a look at the CTAs here. What are the CTAs doing? I'd say neutral up on the S&P and of course a little bit up here on the NASDAQ. So they've been buying a little bit more as we've been rising into this 5,500 level. Meanwhile, Brent, very interesting analysis here to come up in today's show. Doesn't show too much movement there. And gold seeing its first uptick in quite some time. So gold actually seeing a little bit of CTA buying coming back in. On the other major stocks, we're still in a massive positive gamma environment for NVDA, which means that basically anywhere here, if we keep pushing through, specifically the 135, 140 zone this week or next week, and this week will be the most important one here, then we continue to basically see hedging coming through. Now, at the moment, the spot price is 131. So if it does push through 135, close above that, expect that to be like another one of those catalyst events that could get us even to 140 from NVIDIA's standpoint. Meanwhile, Tesla also experiencing positive gamma for the first time in a while, making it through the 185 zone, 182.50. Now, of course, we've loved this area as a breakout. We saw it break out, come back down to a gap fill, giving another opportunity, and now it's rallying forward. I think the logical scenario here is to see it just before $200. So this week is a massive expiration. Of course, if it does get held under 185, sure, that might end this current rally. But for now, we are in positive gamma. So of course, a lot of people are going to be looking towards that 200, which will be the gravitation zone for that particular stock. We'll look at that soon. Here are some other warning signs, I guess, for exhaustion. They're starting to stack up a little bit now. We've got the bonds market, the yields in the bonds market, the options market side. That's starting to spike up. We often consider this an early warning sign that markets are starting to get a little bit shaky. Remember, we got one recently, which led into the fall, and we've seen a couple of other ones, such as this one that happened in September, which started to spike in August and then really spike in September, which led into that further sell-off that went through October. So it's quite a good read. It is starting to give us a little bit of warning signs. For the longer-term investor, home builders still holding strong, so that's a good sign. DJT a little bit weaker. XLY, XLP better, which is again good sign at the moment for pullbacks to be met by bull demand. And I think that overall there's a difference between the investor and the trader right now. Traders, I can totally see exhaustion even though we're in an upward trend, and an investor's going to say, yeah, but we should have a lot more room to run based on the metrics at this stage. And I think I'd agree with both of those scenarios. US dollar, meanwhile, did hit into that resistance again. I'm not too sure whether the dollar is going to be able to get through this area, but this is the final major supply zone. So dollar, very difficult trade here. I don't find it too easy. You could argue, well, it's easy, I'm going to short it. But if it does get through 105.50, I think it's going to go quite long. Let's move over to copper. That's, of course, sitting around a critical level, probably waiting for the US dollar as well. What is it going to do? And copper remains kind of range bound. Move on over to gold. Not too much information coming out of gold. We saw CTA start to improve on it a little bit. Hasn't really given me a great signal towards rebuying it. As you would know, if you've been watching this channel for a while, I do think gold's going to hit $3,000 an ounce over the next 12 to 16 months now, and I am still positive on it. I'm not discounting the fact it could fall through this low though, but I would prefer something like this. This would be pretty cool. Even this is actually not too bad, and it may sound cataclysmic, but remember, too many people were long over here, so I don't mind it consolidating. that is a-okay with me. It's exactly what you would expect after such a phenomenal move. Remember, gold is the second best asset class pretty much of the majors for 2024 so far in terms of raw percentage. So it's been pretty nice. US oil. Now, this one was really good breakout. So this is pretty much what I was talking about in our Market Masters Club, and I've been discussing a little bit. I suspected that oil might actually be setting up for a long. Now, I really wanted it to go down a little bit before it went rally. I think that would have been a very nice, 8-to-1 style ratio trade, actually. But instead, what it did was it built consolidation, went sideways at a very important zone. This was the most traded level, and then it breached that over the last 24 hours. So I just want to kind of show the smaller time frames here. We'll go down to the 2 hour. You can kind of see here, it gets ready. It actually makes a series of higher lows and then breaches right here. Now, as a day trader, if you wish to, this is a good breach zone for having stops below the low and basically taking it as a momentum. Certainly a nice breakout. It's now hit into the resistance, but I would say that pullbacks will be met by bull demand. I think oil has those kind of rally here. It has those signs that it's going to probably go now towards 83.50, 84.50 a barrel. So this area up here that we've talked about for a while, oil certainly looking longer than it was just 24 hours ago. Now, you might say, well, it's getting exhaustion. Sure, but I do think it's setting up quite nicely there. All right, let's move over to Tesla and the stock markets in general. And Tesla came back off the gap fill here, one of those big, giant transactions that went through, and it bounced big time, engulfing back up. And I think this is looking quite strong. Daily shows it looking bullish. Again, our opinions don't really matter on the stock. It's more just the price action. And you'll notice you get that perfect gap fill and just come out of the gates very, very strongly. Really, the signal is here, in my opinion, that was bullish. Then we had those two kind of nasty red days, but we still broke out. And then we pulled back leading into this. So I'd like to see this thing actually make it towards 199. Do you think it can do it though? Let me know in the comments down below. This is now the most important chart I would say to be watching over the next year. And that's going to be semiconductors versus SPY. Remember, we expect the market, if we're in a growth concern, to show a ballistic move followed by a huge sell-off. Because we're in a concentrated market, I think it's going to be a little bit different. I think that if we're having to do rate cuts, it really is going to depend on the speed of the Fed. If the Fed does 2 rate cuts, that is 50 basis points of rate cuts within the first 2 rate cuts, or they even say they're going to do 50 basis points, they broke something, it's stuffed, and that is not a good sign. Very bad sign, okay? So we do not want to see 50 basis point rate cuts. That's the first thing. The second one's going to be, how does semiconductors perform? This market will be, if this is turning over and starting to really fail, then that's a great sign that usually we're over the bubble and bad things are probably coming. So semiconductors versus SPY, we'll talk more about that in the future. Now let's move over to the NASDAQ, because again, yes, it's in an uptrend. I understand it's a very good uptrend. An investor, swing trader, probably not going to care. Day trader, somebody else, I'm probably going to start looking at this and saying, wait a second, we're getting back to those exhausted periods again. So yes, we've just hit almost, well, I think we almost basically did hit the 20,000. And that is, again, a big round zone, a huge round number. And this is showing, again, that we might be at a point where I think we've got some resistance. US 30, on the other hand, well, it's still weak. It's still underneath the supply. And I do think that that is something that we can, consider. And then, of course, we've got the US 2000, which is the Russell, which is kind of floating all over the place, up, down, and all around. Actually coming off the downward trend line here and finding a buyer. So I'm not really loving the Russell unless it breaks this 2100 zone. I think down here, it's just very difficult to trade it with excellent entries. We liked the tweezer the other day over here as a day trade kind of thing, but then it instantly failed. And that's the problem with the Russell right now. We even know it in the stats. The Russell just doesn't perform as well in these pre-rate cut environments. It usually does much better after the cuts actually happen, if we're in a normalization or even a growth scare type of situation. All right, well, let's jump on over to some other market conditions now. We've got the Chinese market, HSI. Been watching this very closely, looking for it to break out 18.2 to really show strength. But one of the stocks I think that's been a bit of a breakout has been Tencent. And the reason is because Tencent's been leading that market. It's kind of one of the most important markets out there for the Chinese stocks. And you'll notice here, it's still holding up since we first talked about it. So it's starting to try to break through, looking for a new high above this zone. So 10 cents certainly one to watch at this point. All right, let's also break down crypto and have a look at what's going on there. So crypto took a new low over the last 24 hours. You'll notice I put a little watch reaction here line around 64.5. So this was my bottom end of what I expected. Basically, I thought the market would come down here and I was looking for wicks. Big, strong rejections off this area, basically showing a big buyer has come back in. And we don't have a big buy confirmation just yet, but you'll notice I've put in first bull level and major bull swing zone. These are the two levels that I think would be key. Now, narratives aside from the Bitcoin market, I think we're just looking at potentially here a shakeout, which could be very, very interesting for Bitcoin. And this is typical of what the market does. It loves doing good shakeout. Just think recently when it went down to 57.5, it hasn't shown a sign of significant strength yet though. So it's going to probably need to get through at least the first bull zone. Then, more speculative day traders will come in. Of course, I think the big key level is going to be around 70,250. So certainly watching BTC specifically. I'm also watching alts right now. I think they're very interesting. And you'll notice that we're sitting on that anchored VWAP off the low. So this is another key point. Structure, low hit, anchored VWAP. Quite a lot of things to like about Bitcoin finding these. So while everyone else is freaking out, I've actually seen Twitter X whatever comments, people saying it is the worst crash they've ever seen. You can tell that account hasn't been around for long in crypto yet. It's absolutely wild. I can't believe people can post that about crypto. It's not even close to the worst crash. But you know what I'm saying, yeah? The sentiment is lower, and that's usually a good sign to be starting to look for price action to show you the way. For this week ahead, what have we got? We've got RBA rate statements, those types of things coming through. Then we have core retail sales and every single one of the minor FOMC people coming out and having a chat. You can see they're all over here. Core retail sales will move the markets. That's on Tuesday. Of course, that's going to be a mover. And then really it's mostly other central banks until we kick things off again for the US, which will happen with flash manufacturing PMI on Friday. Core retail sales being the most important though. So expect a bit of volatility before the Tuesday open, and maybe this will be one of the catalysts that moves the markets, possibly in the bearish side, just because we're starting to get close to those OPEX levels. Be careful of the 5,500. We'll keep updating you throughout the week. Remember to subscribe if you enjoy the content, and thank you so much for watching. Bye for now, guys. See you in the next one.